Hi, my name is Mike Tusaw. I'm a financial advisor from St. Charles Wealth Management. Today, we're going to have a brief discussion on the option Greek rho. We will be discussing the definition itself, how it actually affects option pricing, as well as a basic understanding of how it can be used. So, by definition, rho is the Greek that tells you how much price movement an option will have based on a 1 point change in interest rates of a U.S. government treasury. Now, have an understanding that this is under the assumption that interest rates are in a vacuum. If all of a sudden the Fed were to raise interest rates 1 point, the option price would move what the definition says it would, but understand that in reality, the market itself would actually move the option a lot more than what the interest rate actually would, most likely. So as you're going through this, make sure you have an understanding of all the Greeks, not only just rho. Now, the way with which interest rates affect the pricing of options, call options have a direct correlation, puts have an inverse correlation. So in other words, let's say that interest rates go higher in a vacuum. Remember that we're going with being in a vacuum right now. Markets can have other effects on things based on what interest rates do to markets. But in a vacuum, if interest rates go higher, call prices go higher. Interest rates go lower, call prices go lower. On the put side, interest rates go higher, puts go lower. Interest rates go lower, put values go higher. Now, why is that? Well, let's focus on the call. Let's say that interest rates are higher, then you can become more motivated. Instead of buying a stock, you'd just rather, let's say, put money in a government treasury and buy a call option. Well, for someone to take the other side of that trade, theoretically, of course, then the value of the call becomes higher because you're going to want to get that U.S. government treasury interest rate that much more. And that drives the price of call options higher. And of course, if there is a lower interest rate, then that would drive the price of calls lower. Once again, I can't emphasize it enough. This is in a vacuum. This is not having any other effect from the market itself. On the put side of it, let's say then that you still want to be hedged or you want to have limited risk on the stock. So instead of putting money in a government treasury and saving some for a call option, you then just buy the stock and buy a protective put. Well, if interest rates are very low, and if someone's on the other side of that trade, if you will, and they're selling that put option, it's going to be a lesser cost on the put side of it. So it's an inverse relationship, and that is why. So how can this actually be used? Well, I think there's a lot of ways with which it can be used, but I think the main way to use it and just to have an understanding of it, and this can apply to a lot of other things, is in comparison to a covered call versus a short put. Now, back in the old days when I first got into the business, when the dinosaurs roamed the earth, they had these things called commissions on stocks. And so there was a factor that you had to look into of should I sell a covered call or should I sell a cash secured put? From a synthetic standpoint, there really is no difference in it. And so when looking at this, what had to be factored in is if you had a smaller account, then you're going to pay a commission on buying the stock as well as selling the call option. Now, commissions don't exist in most places. They still do in some areas on stocks. They only exist on options. So from a commission standpoint, there's no difference than selling a covered call and selling a cash secured put. So now how do you make that decision? Well, if interest rates are very high, once again, values of calls will be higher. And so you'll get more premium typically when selling a covered call. Now, if depending on your broker, most brokers, if you're selling a cash secured put, the maintenance that you're going to have, the maintenance requirement for that cash secured put will not be earning interest. Once again, let's say XYZ stocks at 50 a share, you buy the stock and sell the 50 covered call, or you just sell the 50 put. the $50 that has to remain in maintenance under the short put likely is not getting any interest paid on it. Check with your broker, but a lot of times it's not. So if that is the case, you're likely better off selling a covered call because the price of the call is going to be higher. Now, if you're getting a nice interest rate and the cash that you have on the on the maintenance, then your decision gets altered. But most of the time in the retail world, you are not. So when using it, have that understanding. And finally, if you have any questions on anything, feel free to reach out to me, mtusaw at stcharleswealth.com. Have a wonderful day, everybody.